What's going on, you guys? It's Marcos. If you own a home right now, congratulations. Odds are you gain a significant amount of equity, especially in the past couple of years, and you've got some amazing amount of money right now. Maybe not in your pocket, but obviously in your home. So congratulations anyways. But listen, as a homeowner, one of the most responsible things you have to do is to always ensure that your investment is secured by the right type of financing at all times. Because having a mortgage is a lot different than having a car loan or a secure credit card or just a regular credit card or a personal loan or student loans or just honestly any type of unsecured debt. Because stretch over a long period of time, even overpaying $25 a month can become into thousands of dollars wasted. So today we're gonna talk about the top 4 smart money moves that you have to make ASAP as a homeowner right now. All right, the top move that I would say that you have to make right now is gonna be refinancing your mortgage. And look, if you own a home and you have a mortgage, refinancing may always be the best move that you can actually make. Now I'm gonna give you a little bit of history. Back in 2020, the Federal Reserve dropped the Fed funds rate to nearly 0% and began purchasing over $120 billion a month in treasury bonds, mortgage bonds, which obviously caused mortgage rates to drop to basically the lowest levels in history last year, and as a matter of fact, into parts of 2021. But in the past few weeks, interest rates on mortgages have been going up at a pretty significant rate, and actually it is very likely that they will continue to go up in the near future. Now you want to take advantage of refinancing because obviously when rates drop, then it may become an opportunity for you as a homeowner to take advantage of the lower interest rates. Now as the COVID pandemic comes into an end and the economy appears to be in a better position as well as the worry of inflation, the Fed is looking to start tapering those bond purchases, and the demand for these mortgage bonds will decrease, which is going to start pushing up those yields. And of course, it will make up these rates to start going up. Now, refinancing may actually be the easiest and honestly the biggest way for you to save money on your mortgage. Unfortunately, most people are completely uneducated about the benefits that it can bring, especially in the long term. You see, with a refinance, you may be able to drastically reduce your monthly payments, pay off your loan faster, access tax-free equity from your home, consolidate high interest debt, and even more. Now, I'm not gonna go into too much detail about what a refinance looks like in different scenarios because I have made several videos in the past about these topics. So if you wanna check out a little bit more, I'm gonna put those descriptions in the description box below. Did I just say description? The description box below? I'm gonna put the links in the description box below so that you guys can just go ahead and watch at your leisure on how I walk people through just different scenarios on refinancings and even some scenarios in which you can literally save hundreds of thousands of dollars, and even one scenario where I show that it's even possible to save even $2 million on just a regular refinance by refinancing your home. All right, number 2 is gonna be paying off high interest debt with a refinance or with a home equity line of credit. Now, unfortunately, millions of Americans live paycheck to paycheck and most carry an average of over $5,000 in credit card debt at an APR of 16%, over $30,000 in auto loans as well as student loans, and needless to say, the debt problem in this country is still pretty horrible to this day. Now, if you have a good amount of equity on your home, it may be wise to consolidate all your high interest debt into your mortgage, and here are the reasons why. You see, for the most part, you will drastically reduce your overall monthly cash flow. Consider this. If you owe $400,000 on your mortgage at a 3% interest rate, your monthly payments, excluding taxes and homeowners insurance, is gonna be somewhere around $16.92 a month. But say that you have $50,000 in credit card debt or unsecured debt or a combination of both. So what you could do is you could refinance your mortgage at $450,000, covering the $50,000 that you have in unsecured debt at say 3.5% interest rate, which is very common right now at this time of the moment. And your monthly payment on a 30-year fixed mortgage will go up to say roughly about $2,020 a month. Now, of course, on $50,000 of debt, you're probably paying an average of say 3%, so that might be somewhere around $1,500 a month. So you're gonna be saving a lot of money and open up your cash flow because of the savings that you won't have to pay these $50,000 anymore. But sure, I know your payment on the mortgage went up by maybe about $400 or so, but again, you're gonna be saving so much more money. If you were to reinvest $500 a month into the new mortgage payment, into the new loan at $450,000 at a 3.5% interest rate, you may possibly be able to pay off your loan in under 22 years, actually somewhere around 21.08 years. So you essentially were able to cut 9 years on the mortgage, as well as save a ton of money in interest, actually about $90,958.78 worth of interest payments just by doing so. Now, in addition to this, you may be able to take advantage of a higher tax deduction because mortgage interest is tax deductible. Now, interest on credit cards, car loans, personal loans, student loans, even if you make over a certain amount of money a year, is not. All right, number 3 is going to be getting rid of your mortgage insurance, otherwise known as PMI. Now, if you bought a home and you put less than 20% down, or you took out an FHA mortgage to purchase a home or to refinance, you're most likely paying mortgage insurance. Now, mortgage insurance is the reason why you're able to buy a home with less than 20% down. It insures the lender of losses if you stop paying on the house and obviously the property goes into foreclosure. But this is a monthly payment which benefits the lender and not you. Don't confuse mortgage insurance and homeowners insurance, because mortgage insurance, again, it protects the lender. Homeowners insurance protects the home. A lot of people believe that mortgage insurance is a protection for the borrower, but it actually isn't. Now, you can only remove PMI in a couple of ways. Now, if you have an FHA loan, the only way to remove the PMI is by refinancing it into a conventional mortgage. This is literally the only way, unless you bought a home with 20% down and you paid at least 7 years into it. This is very unlikely for people that do an FHA mortgage, because most people that buy a home with an FHA loan do not put 20% down. Most of the time, they just put a 3.5% or a 5% down payment. FHA actually mandates the PMI for the life of the loan if you just did the minimum down payment or anything under 20%. This is why you have to refinance into a conventional loan to be able to remove the PMI. Now, if you have a conventional loan with PMI, you may be able to refinance into another conventional loan that does not have PMI, granted that you have enough equity in the property to avoid it. Also, one thing that you can actually do is to just simply call your lender and request them to have the PMI taken off. This is very common, especially if you've been in the home for at least a couple of years. If you believe that you have enough equity for you to avoid paying the PMI, just call your lender, tell them that your equity position went up drastically. The lender will come and do an appraisal on your property. You will not have to refinance, and they'll remove the PMI for you. Now, I've seen this typically happen if you've been in the property for at least a couple of years. You've at least been making those mortgage payments on time without missing any payments whatsoever. And just so you know, you have to have at least a 20% equity position in the property for the lender to remove PMI, or if you're refinancing into a conventional loan, you have to have the 20% equity position. Otherwise, what they call 80% loan to value. Now, it goes without saying that whatever loan you have, regardless of what it is, removing PMI as soon as possible has to be on top of your list, as most homeowners actually pay an average of $1,500 to $3,750 annually. All right, number 4 is going to be getting a line of credit on your home, otherwise known as a home equity line of credit, otherwise known as a HELOC. Now, a home equity line of credit might be one of the most powerful financial tools that most homeowners have and also have absolutely no idea about. Now, the biggest one is because a HELOC gives you complete control over your home's equity at all times. This is like literally having a credit card with your home serving as collateral. But the key is to use it when there's a need or there's a bigger financial gain, and not because you just want to blow your money on stupid things. If you have an unforeseen expense that you have to pay, use the HELOC. If you have an opportunity to invest in something else, buy another piece of real estate, then you just tap on the HELOC. You need to pay off other debts that have a higher APR. You have some other big payments somewhere else that you just want to consolidate. Use your HELOC. As you can see, the amount of use that you have with a HELOC is very expanded. I mean, you can basically use it for pretty much anything. Also, depending on your tax bracket and what the state that you live in, the interest rate on the HELOC can also serve you as a tax deduction. And also, the other thing about it is that if you don't need it, you don't have to use it. You can just leave it at a zero balance until you need to use it, and there are no penalties for not using your home equity line whatsoever. So this is extremely important because, well, there's no penalties. You have a need, you have to use it at some point in the future. Great, you go ahead and do that. The other thing is you use it, you can pay it off in full, pay absolutely no interest. You can definitely do that. So as you guys can see, it's just so much flexibility with having a home equity line of credit. But once again, guys, use it responsibly. Because if you start using your home as an unlimited ATM for vacations, Gucci purses, and red bottoms, at the end of the day, you're gonna find yourself in a pretty big world of hurt. And that's basically it, guys. Nice, short, and sweet. I wanted to get straight to the point in this video. These are really 4 huge financial moves that you have to make if you haven't done so already, if you're a homeowner right now in 2021, and even moving forward towards 2022. If you guys like the video, make sure that you subscribe to the channel, give it a like, share it with your friends, and I will see you guys in the next video. Thank you for watching.